So hi, good morning. Welcome everybody, and thank you very much for joining us for today's session. That's about the new era of debt collections. I would like to thank you for our panelists who are with us today. I would like to thank you for the IBS Journal who are with us today, and primarily thank you for everybody, for customers, potential customers, partners, potential partners who are joining us for this session, where we would like to share with you some of our thoughts, how we see the major challenges that is ahead of us in collections, that is driven by the changes in the economic environment, that is driven by the major changes, the fourth technological revolution, that is completely changing the way how we see collections today compared to yesterday, that is driven by how banks are changing because of these technological and economic changes. And then I would like to give the word to my colleague, Adam, who will be the first speaker today, talking about an unpredictable era of debt collections.
Okay, thank you, Tamás. Good morning, everyone, or in some cases, good evening. What should we prepare for in the upcoming period on the NPL market? Are there certain actions or practices how market participants can gain competitive advantage on this dynamic market? Before we get into the details, allow me to share with you a couple of relevant information about my company, Loxon Solutions. Luxon is a business solutions provider bringing business software solutions for the financial services community, covering the end-to-end lending, collection, and risk management lifecycle. This market niche is our core competence. We do not cover any other industries or business domains. Loxon is originating from Hungary, and in the last 20 years, we have become an international vendor with more than 80 customers on 4 continents. You can see some of our references here. Let me highlight 2 of those. One is the ING Group, which is one of the 25 largest banking groups on earth, where our collection system is a group standard, or Home Credit International, one of the 5 largest consumer finance providers on earth, where our collection system is also group standard. After the brief introduction, let's take a look at the underlying debt market landscape. During the pandemics, many countries implemented some sort of moratorium package in order to avoid dramatic default rates and a downward spiral in the economy. There was a strong expectation on the market that once the moratorium period is over, the NPLs will start rising substantially. I believe that we can all agree that the experienced NPL increase was under these general market expectations. However, there was another threat creeping in quietly, was inflation. Heated by the extra cash accumulated during COVID, it generated demand side shock for the goods and services, and in the meantime, also supply side shock, meaning inadequate supply on the energy market or agriculture market, partially caused by the Ukraine crisis. And also we could experience supply side issues on other markets, like products or materials from China, or not adequate supply in chip manufacturing, for example. So having parallel attack both on supply and demand sides, inflation suddenly jumped to levels not experienced during the past couple of decades. So central banks' natural reaction is the continuous increase in interest rates, thus resulting in higher and higher monthly installments for debtors. This has an obvious effect on the NPL market by increasing both the number of delinquent debtors and the amount of NPLs. We should also note that even after reaching a peak in the level of interest rates, we still may experience further increase in NPL simply since some loans, typically mortgages, might have fixed interest rates for a couple of years and will get adjusted to the higher interest rates potentially only after 1 or 2 years of delay. So under these circumstances, it is not surprising that financial institutions are putting higher and higher focus on prevention and provide more personalized experience to their customers, applying digitalization techniques. Fintech applications set the bar for digital experience, and banks try to catch up with their mobile platforms. These new platforms, digital channels, open up new opportunities also from the NPL management point of view. Banks can use these platforms beyond supporting the everyday banking activities to convey client education materials and explain what options the client might have in case of payment difficulties. Better informed clients can be more open to payment agreements or restructuring options offered by the bank in case of payment difficulties. Furthermore, by using mobile application, the delinquent clients might be addressed with hyper-personalized payment promises and restructuring offers via push messages. Certain client segments, particularly this is true for younger generations, can be more responsive to such initiatives supported by chat functionality with bank experts than for more intrusive phone calls. Banking mobile applications can provide huge amount of useful information for detecting early warning signals. Beyond the regular triggers, and under regular triggers I mean like withdrawing up to the credit limit from all available sources or less incoming monthly transfers. So beyond these traditional triggers, bank can get a lot of useful behavior information when using mobile applications. This leads to the question how banks should consolidate this large amount of potential information and gain real benefits out of it. How to set up data governance model or clear data lineage. Collection activity is based on data originating from numerous other data sources, can be both internal or external. The value date of data, the accuracy of data, or the reliability of the data all can be different. This is why data governance and data lineage play a vital enabler role before we can start talking about well-managed BI or start utilizing our data potentially with some artificial intelligence support for predictive or even prescriptive analytics. Such techniques can be very useful to support the decision on collection exit strategies. For example, whether or not to get into lengthy legal procedure with the client or just simply sell the contract. So these decisions can also be supported by AI models. We can also observe a tendency of using more and more advanced segmentation methods when determining the appropriate collection strategy. From the traditional product-based or client-type-based segmentation methods, which potentially also incorporate risk attributes of the client, we started moving towards the usage of hyper-personalization approaches at certain points of the collection process. For example, in case delinquent client uses a self-service mobile application, we can approach him or her with hyper-personalized payment agreement options, which were tailored for the client's assumed circumstances. Also, we can further fine-tune our collection strategies by using external data sources or business services, but the issue around the integration, such type of integration, might get complicated. So what can we do with this problem? We believe that composable banking can help this problem and contribute to the success of our collection strategies. Let me highlight 3 major pillars of composable banking. The first pillar is the move from monolith systems to microservice-based, API-driven architecture, which is cloud native, thus making it easy to access the surrounding financial ecosystem and the provided open API-based services. This way, it is possible to reach external services or data sources on a need-to-access basis without huge unnecessary infrastructure investments. The second pillar is that the collection system should be based on separate, flexible business modules that can be mixed to find the optimal solution. And the third pillar is the agile iterative approach that ensures quick reaction to market changes, which we can experience more and more nowadays. On the previous slides, we have covered challenging topics such as supporting hyper-personalized client approach, advanced segmentation methods, or the concept of having separate flexible business models. We touched upon the importance of having a cloud-native, microservice-based, API-driven architecture. All of these and many other functionalities, such as advanced reporting or 360 customer view, are supported by our newest generation of collection system, for which you can see here a brief summary. However, I would like to specifically highlight two aspects on this list. The first one is that during our system implementations, we use predefined business templates covering the typical business workflows, screens, business functions. These templates were created based on Loxon's best practices, accumulated during many years of collection system implementations. This approach makes it possible for Loxon to deliver a turnkey solution, thus drastically shorten the implementation timeline and reduce multiple risk factors that we're all aware of associated with new project implementations. And the other aspect I would like to highlight is that by having a standard business template or business template-based turnkey solution, it can be easily customized to local specific needs by using our graphical no-code platform toolset. So in case some extra fields, workflow steps, additional conditions for decision points should be added, this can be done with ease in our platform. Finally, if you are further interested how we see the key challenges shaping the collection industry, you can refer to our white paper on this subject, which we recently published together with IBS Intelligence. And if you need further information on any of these topics, feel free to get in contact with us, and we will be happy to help. Thank you very much.
Perfect. Perfect. Thank you so much, Adam. This was great, and I think all the topics that you briefly covered in the past 10 to 12 minutes. I think we are going to cover each of those topics in a slightly more detail, and we're going to put our panelists these questions and get perspectives, multiple perspectives from different geographies as well, and to add more color to the points that you mentioned. So thank you so much, and it's time now to start with the panel discussion. Let me first introduce my panel members today. First, we have Rajiv Nanda. He's the head of collections and recoveries at Standard Chartered Bank in Singapore. Good evening, Rajiv. He comes with 2+ decades of experience in retail banking, credit operations, business process operations, and business transformation. He has a deep understanding of credit and the collections business, and he has created multiple strategies across multiple geographies related to collections. So, and a really great person to have on the panel who will be able to answer a lot of nuances around collections.
Thank you.
Next, we have Kaan. Kaan Aksel is a director in the risk and regulatory practice at PwC. Kaan has worked on several strategy projects in more than 30 countries with a focus on financial and credit risk management. He helps his clients in reviewing internal models for Basel II, 3, IFRS, and also helps clients do stress testing on their credit portfolios. Kaan, welcome. Thank you so much for joining. Last but not the least, we have Tamás. Tamás Erni is the CEO of Loxon Solutions. He joined Loxon in 2001, and he has been instrumental in navigating Loxon into one of a major vendor in the risk management and lending software solutions market. It is now active in more than 25 countries, as Adam mentioned earlier. He's also built the business consulting team of Loxon and really helped several banks in transforming their lending operations. So welcome, Tamás.
Thank you.
Perfect. And my first question is going to come to you, Tamás. First, let's start with why are we even discussing this topic? Why is debt collection such an important topic to discuss given the today's economic and financial scenario?
Well, debt collection actually gains bigger and bigger importance this year, and also everybody expects in the next years to come. And the reason is multiple folds. So we see how the economic conditions worsen, inflation is soaring all over the earth, and we already see a rapid increase in the interest rates. When we see the economic press, every week, basically, we see dozens and dozens and dozens of articles, speculations, predictions about how the central banks will increase the interest rates. We have heard about the surprise increases by the ECB, by the Federal Reserve, and so on. So inflation is soaring, interest rates are increasing, and within a very, very short period of time that is unheard of in economic history, the economic conditions have completely changed from a market that was overflown with money and where interest rates were around 0 or even negative in the advanced economies, to inflation and interest rates that we haven't seen since the 1970s, basically. So even the generations that are now leading the major financial institutions started to work around, but even after the time where we have seen such massive interest rates. And these economic conditions heavily impact the customers of financiers. In the last decade, we are used to close to 0 interest rates and limited interest rates that we pay for credit cards, for any types of borrowing. Now it changes. This means that the monthly installments of any type of credit will increase significantly. So it means a bigger and bigger chunk of the monthly disposable income of the retail and SME customers. So it will have a strong impact on our customers. Also, we see on the banking market that there is still an intense competition for retail and SME customers. So what does all this mean to us? We can see these changes from a customer's perspective, and it means that more and more customers will experience collections. In today's economic conditions, customers expect that collection should be an as positive part of their customer journey as anything that they have experienced before during the onboarding, during how they very easily got to their credit, and so on. So collection today has to change completely. It is not anymore the collection of the traditional times where collection was there to collect the money, to recover the money from the customers, not anymore. Collection has to become a part of the positive customer journey, a positive customer experience.
True.
When we see it from the bank's perspective, the banks need to be prepared for this. As more and more of their customers face financial troubles, they have to be ready to refocus from recovery to the customer relationship, identify the customers that are ready, willing to pay, identify the customers who are not necessarily willing to pay, but can be convinced to pay, and primarily keep all the positive customer relations, find mutually satisfactory ways of repayment, and even more important, showing to their customers that their bank sees them as partner and stands together with them, even in problematic situations. And also there is another aspect of collections, that the worsening of the economic conditions means that the cost of financing, the cost of many very popular retail products is heavily increasing. Just think of consumer loans or the now very popular buy now, pay later product, where the overall financing cost goes up significantly because the prices of the products increase and because the interest rate of financing increases. And even though the cost of BNPL is now paid by basically the sellers, the commercial partners of the bank who are selling the consumer goods, it's a question for how long they are ready and able to finance all this cost. And lastly, what we will witness now is a real-life testing of how the new risk models that we have prepared during the course of the last many years, alternative scoring based on alternative data, alternative risk management practices, products that we have only seen now when the economy was going up. How will these models behave in the tougher economic conditions? And because no one yet knows the response to these questions, that's another angle why it is of utmost importance for the financiers to be prepared on the collection side to manage the expected wave of increasing problem loans.
Perfect, Tamás. I think you put in a very wide lens of why we are talking about debt collection today, why it is such an important topic. Clearly, I think it's a very apt title that we have in that sense, because we're talking about the shaky recovery, which I think is the shaky economic recovery, and that is going to directly impact the recovery of loans or recovery of money. So we don't want to make sure that experience is not shaky, right? I'm going to bring in Kaan. Kaan, in terms of, do you see there is a difference in terms of the credit uptake across different geographies that you have experience in?
Yeah, I think there's really a significant difference between the Northern Europe or Central Europe and the Southern Europe. If we need to focus on the collection activities and their importance. One reason for that is the market is practically dominated by saving banks, and and most of the loans that you might be able only get in other countries through commercial banks, you're getting from the state development entities in Germany, for instance, as student loans, as an example. and you get substantial actually benefits by this, and there's heavy state interference in these countries, and the so-called retail markets are not necessarily, I would say, developed to the extent what we can observe easily in the southern countries. So essentially collections has been perceived in Central Europe, at least, not necessarily an important item until recently, because most retail portfolios are dominated by mortgages. But here again, we might see a reasonably increasing concern on the eyes, in the minds and hearts of the bankers, simply because the interest rates is increasing dramatically. The last 3 months, the interest rates for 10-year mortgages increased from around 1% to roughly 3%. And this is a threefold increase in interest use, which is huge, at least for this part of Europe. And therefore, I think the concern is, as you and Tamás alluded to this, about the near future, when the market starts realizing that the recession hits the economies, the unemployment rate starts increasing, likely. I mean, and there's no guarantee for that, but if that happens, the chances are high that we might have collection issues, which wasn't the case. I mean, as some of you might have been observing it, we have sizable mortgage portfolios with 250,000 counterparts being booked the last 3-4 years, and in these portfolios you hardly have more than 5 or 10 defaults, and hard to believe that anything like that could happen. But it was the phenomenon of the so-called low interest rate environment, and might easily come to an end, and we might wake up one day to the reality that we have on one shot tenfold increase in default rates in these portfolios, and then the banks might not necessarily be ready for this. Having said that, the regulatory push has arrived in the form and shape of loan origination and monitoring requirements imposed by ECB, European Central Bank, and that gave rise, first time of many banks starting collecting collection relevant data. In most banks in Germany, as an example, we don't have collection scoring models, and therefore I think this area of banking retail activity had been treated more like a foster child. But it will change. It will change, and then the banks will realize, as first thing first, you need to have a platform to collect the data, to embed your models, monitor the models, get the outcome, apply the challenger strategies to improve the collection, optimize the collected amount from the receivables. And it will be interesting to see how in some of these conservative countries, banks will react to the new realities if recession hits the Central European environment towards the end of the year, I would expect. Yeah,
you did use the dreaded R word, right? Recession word. I really hope it doesn't come to that. But yeah, I know I think the economic conditions are changing.
It's reality. It's not. I mean, if you live in Germany, Austria, France, you see that the activities have been sizably squeezed right now. You cannot produce as in the past because of the supply chain issues. This hurt us big time. I mean, in a country like Germany, which is known to be producing cars, you cannot find cars to buy. Or, in Austria, this is a country famously known producing musical instruments. Go and try to get one piano. I mean, it's impossible almost, because supply chain problems make it impossible that the production can be kept up on the same level. And that's, I think, going to hurt us at some point in time. And reality is the Central European banking system don't have the means and the instruments to handle or absorb the shock of serious recession. That's the message I want to convey practically.
Wow, so it's very good to have a on the ground check, or the reality check of what's happening. So Rajiv, I know Kaan actually gave a lot of examples in and around Europe. Before we get into the actual digital lending aspect, do you have any insider on how the credit uptake and how this is changing in Asia per se?
Yeah, I think interestingly, thanks, Nikhil. So interestingly, I think in some of the economies here, we've had the opposite of a recession actually earlier. The pandemic has proved to be something very different than what we expected. Apart from the business banking customers, we've had customers who've stopped traveling, obviously, the last 2 years. They stopped spending money in lockdown periods. And we've had them paying down, and delinquencies have been reducing pretty dramatically. Of course, that's coupled with the fact that the credit underwriting has also got tightened because of the pandemic. So we've actually had very, very low delinquencies. But having said that, I think now, just as Kaan was saying, the inflation's up, people are out spending money, interest rates are rising, so the monthly installments are starting to go up in the mortgages. I think in the next 6 months, 4 or 5 months, I think we will start to see an uptick in delinquencies around this region and globally, I think. And I don't think it's too very far away. I think we're already there, and now we're kind of starting to go up. We will see it in the next couple of months for sure, I think.
Interesting. I think this is a very interesting takeaway already that I can put out for our attendees, that look out for troubled collection times in the near future. And talking about debt collection, and how digital is going to really help and impact. So I'm going to stay with you, Rajiv. Let's get getting a banker's perspective as to we talk a lot about digital, but what really is, when we say digital debt collection, what exactly is it, and how is it maybe slightly different from the traditional ways of doing collections?
So I'd start by, of course, continuing what Kaan said. Collections has always been in the background. You haven't really had that importance that we always wanted. Very interestingly, there was a global meet I'd attended many years, 10, 15 years back, where there was this whole thing about marketing, right? And how you segment the customer base and how you land up figuring out what channels to use and how you market to these customers. The takeaway I had from it was, and especially in a banking world or on a financial institution, we do the same things in collections, right? It's just that's so much tougher, because when you're selling in loans, you're giving money out to people. People are willing to take them. We are the ones who say you can take it and you can't take it, right? But when it comes to collections, we do the same amount of stuff, same amount of hard work, and then after that we ask them to pay us. So it's it's so much more difficult. The challenges are pretty much the same, or if not more, I would say. Reaching customers is so much difficult in collections than it is to reach, let's say, when you're going out in sales, comparatively, right? So just a background that I've always thought that collections is so much tougher. You're doing the same amount of stuff. When I look at traditional collections, so I'll give you an extreme example of something I came across in Spain once. And maybe that practice is still there, but I don't think so. And that's, they used to have, when customers never used to make a payment, and they were fairly highly delinquent, you would actually have someone, a field collector, go out in a certain costume and sit outside the person's house. And that would mean that the whole community and the locality knew that this person owes money, and so that person, out of pure shame, would go out and make the payment. So that is tradition. That's very traditional, right? Then, of course, you had field collections and you had tele collection, where we started. I started 25 years back. Main thing was we called, and I started off with the US collection. So we called and we had field collectors going on in the field. We had agencies, external agencies. So that's what we call traditional today. Interestingly, even regulators have recognized that digital collections has become very important. As of November last year, we've had the FDCPA, which is in the US, which I would think US has always been ahead of the curve, right, when it comes to setting boundaries and setting processes for collections. So the Fair Debt Collection Practices Act actually got amended after 1977 for the first time, where they said, actually, you can go ahead and you can contact people directly through social media. And I think that's a huge leap, especially when you have, the backdrop of data privacy becoming so important. Data, it's the regulators are going completely crazy that you can't send data here. leakages issues and things like that. So that's a big leap. Now I'll just touch upon what digital collections is per se, right? And I think it's been touched upon earlier also a bit. So the two parts of it, as far as I see it, right? One is, like we said, the segmentation, but it's become a bit smarter now. So you segment, you make a scorecard. How do customers react in terms of, how are we contacting them? So when we contact them, let's say the first day after he misses a payment or he or she misses a payment versus 15 days, depending on the customer, the response is very different. So that builds your scorecard. Earlier, we built a scorecard, we had a static scorecard and we went with it, right? Now we have things like machine learning where every day, because of behavior patterns of payments being made by customers and how they're responding to every different type of channel, you can actually be intelligent to learn from that on a daily basis and refresh that scorecard. So that's important because that really helps in terms of, like I said earlier, customizing and it's a tailor-made solution for each customer. Technology enables that quite a lot, right? And that's what we aspire to do, right? So it's like getting an iPhone, but most of us use 5% of it. How do we use the balance of it, effectively with our legacy system, which most of the banks, etc., have? And that's where the difference comes in with companies like fintechs, for example. They have a new technology stack, the new digital banks. They're fairly agile and they can move pretty fast and make the changes very quickly and have APIs where you can have other technologies come in. So that's the treatment part, right? And channel. So there now we had, of course, we've had for some time your SMS, we've had email, we've had chat. Now we have, like a robo-collect where it's an interactive voice IVR where the system is intelligent enough to pick up your questions and answer them also for you. Then you have chat boxes, you can send something, click to chat. So the whole lot of digital things that have come in now. The interesting thing is, how do you make it cost effective? Because even though the loss line is something that everyone looks at, all the banks, but the banks and financial institution, cost is always an issue, right? How are you most efficient when you do it? And these digital channels actually make a lot of difference in terms of substituting and even complementing people who are on the phones making calls, right? A very good example is during the pandemic, for example, technology played a massive role in helping out. You had people falling sick. They were out for a month, they were out for 2 weeks, 3 weeks, right? Where do you get people at that time in lockdowns and things like that? So we had technology stepping in. You had voice blasters going out instead of human voices, you have digital voices going out. Message two-way SMS where customer can actually interact. Technology also made it helpful where you could use the dialer now, and you can actually have people sitting all over in different households making calls. Earlier, it was difficult. Again, some of these features were there, but I don't think we explored them much and exploited them. So now by deploying them, I think it's made a huge difference in terms of productivity and customizing how a customer wants to be spoken to and when the customer wants to be spoken to, so that they respond and make a payment to a particular institution first. And that's how you kind of monetize it.
That sounds like getting first into the queue when it comes to getting your money, right? But interesting the way examples that you gave, and I think Tamás touched upon it earlier about hyper personalization. I think the great examples that you gave here, about the scorecard and how it cannot remain static, but it has to become a little more dynamic as we go forward, right? Very interesting. So I'm going to take a poll question now. Let's see what people think. I'm going to start. So we heard a little bit about the digital collections. So my question here is, what's the most important aspect to keep in mind when a bank or a financial institution is building or shifting to a digital platform when it comes to collections? So should it be thinking first about improving customer experience? Should it be thinking about reducing the operational cost? Is it about enhancing compliance to all the regulations? Or is it, strengthening the data security aspect when you update your platform? Very interesting that, we're getting inputs on customer experience and operational cost is actually second or not even second, third or fourth. So I'm going to hit end poll and very interesting results. I think, while we've spoken about it, sort of the results quickly, it's very interesting. I think while we've spoken about it, the audience here believes that the digital aspect of it is actually helping customer service. So very interesting, folks. All right, I'm going to come to Tamás. We spoke a little bit about alternate data sets. Could you throw some more light about what kind of alternate data sets we are using for debt collection, and what kind of rules, if any, that banks should keep in mind. What kind of data can be used, what can't be used, and things like that.
Well, yes. For alternative data sets, let's start from bank internal. One of these data sets is to use properly the analysis of the customer interactions. And this means when we use our self-service collections, and when we talk about positive customer experience and how collections becomes part of the positive customer journey, then yes, data is one key element, and the other key element is self-service collections. Because through self-service collections, customers can proactively approach the bank, and only from the information when the customer enters the self-service portal, what the customer does on the self-service portal, what are the first clicks, what do they check, what promises they make, we can have a thorough understanding of the real challenge, the real pain the customer is facing, and of course the chosen solution. That's one very important aspect. Another alternative data source, and still let's remain here, is the analysis of the customer communication, speech to text, sentiment analysis, to understand what really happens when our collection agent over the phone talks to the customer. Because whatever is written communication, messages, emails, can already be easily analyzed. Analyzing the calls gives us a chance to understand, for example, what type of collection agent is the best suited to talk to particular customers, how the call should be set up to have a positive discussion with the customer to a win-win outcome. When we move further from the customer, and here for sentiment analysis and basically everything that we do, I would like to emphasize the importance of personal data protection. So whatever we as a bank do, it has to be properly, legally, and from a compliance perspective, authorized. We need to have customer consent for analyzing sentiment or analyzing customer behavior when they are using our self-service app. So these are the most relevant external alternative data sources. In collections, honestly, analysis of social media behavior, we have seen it, but the result was not necessarily very encouraging. We have seen the use of social media data in sales and marketing very effectively, but it was less relevant in risk and in collection until now.
Perfect. You answered one of my questions around, that I always had in mind about social media, and, so can it be used for collections? And interesting, maybe, maybe 1 year or 2 years from now, when we have a similar webinar, maybe there will be more social media, analysis that comes out, which helps collections as well. But coming to you, Kaan, I know earlier Adam spoke about SaaS and being cloud ready. Question, right? There is going to be so much more data on the cloud when it comes to personal data and collections data. First, how safe is it? What is it that how is it related to regulations? From a regulatory standpoint, what are the issues and what should banks be doing to make sure they are in compliance?
Thank you, Nikhil. It's a very wise question. I think what happened is the banks realized because of the regulatory requirements imposed that come under the package of loan origination monitoring papers from ECB and EBA, they start collecting a lot of information, but they were doing just because to meet the regulatory push, not necessarily to harvest out of this data something that would be useful and helpful for any improvements at that early stage. And now they're realizing this data can be used very successfully to identify the rotten apples, if I may call it that way, in the portfolio, and find out which are which customers or which transactions are likely to see some weaknesses down the road in 60 days, 90 days, or even on further time horizon. So essentially, they even started contemplating with the ideas of setting up or drafting some strategies to use this data. But it is, again, it's a very early stage, and they don't have the specialists right now that have this idea of setting up real proof, full-fledged retail collection specialist teams, but they are right now working on it, and essentially at some point in time they will get there, certainly. And this is obviously a more European reality that might sound to the ears of people who have seen the full-fledged retail market activities in Far East and Middle East and in some other Mediterranean countries. They might think this is maybe not even true, but the reality is, for most Central European and North European markets, as the retail markets have not necessarily been developed to that extent, it wasn't really necessary, because the default observations were very small and the expected loss was very small. So there was no justification to set up collection activities to that extent, as we know from the more developed retail markets. But we are coming slowly there because there is a fear. And this fear is mostly steered as well by the stakeholders in the regulatory realm. And they push the market actually to get ready and prepared for that. The one thing most European banks of any size you can imagine are missing in this part of Europe is they don't have a platform. They don't have a system in place. They cannot necessarily, they can collect the data, but they don't necessarily have the means to monitor that. They don't necessarily have the means to apply a certain change in strategy and see its effects. So it's lacking the IT infrastructure that is desirably to have in order to cope with the increased numbers of collectibles. What would happen likely is that when the recession hits the economies here, and when they are seeing the exponentially growing transaction amounts and collectible exposure value in their portfolios, they might come to the very simple conclusion that they need to acquire a readily available platform, because most banks' internal systems are coming from a late 1980s and early 1990s in some traditional banks here. And therefore, I think for them to build these systems themselves, it will take them God knows how many times more. I wouldn't guess anything less than 3 or 4 times more would be not realistic even to imagine So essentially, that's the fundamental weakness that we are facing right now. And also they realize a very fundamental thing when they look to the loan origination monitoring paper from ECB and EBA, that in reality, they can't really collect all these 340 variables, rather than that collecting 8 or 10 of them at all times by a certain standard and data quality, and harvesting out of it a behavioral collection score would be obviously a much smarter solution. You know, you cannot be a lord of so many data points. If you have a chance to be a small token graph or small token chief of 10 data points, that would be a better solution than trying to achieve the objective, which is almost not attainable. I think they are coming to terms with this at this very moment in time. And you know, again, the main I think issue is it's at this very moment a regulator-driven ball game, and once they realize, you know, what they can do all with this data, I'm sure they will be embarking on more technically sophisticated methods, and for that, and they need some data collection platform and monitoring platform and reporting platform, which they might not have at this very moment in time.
You know, it's a really nice segue to my next question to Tamás. But before that, so we're going to ask you a question about the white label solution that, you know, Kaan actually, you know, is talking about, right? About what. So let's say, you know, a bank or a financial institution wants to implement a white label solution. They do not have a platform currently, but they want to acquire a platform quickly. You know, what sort of preparedness do their technology architecture need to have to actually even start using a you know, a best-in-class solution like yours?
Well, I would start a bit further, because it is not only technology. Actually, digital and having digital collections that enables the bank for a proper digital management of their collection practices does not start in technology. It starts from the business. It starts from rethinking fundamentally the way of managing collections. Having a collection vision and a collection approach, a business approach that is created by bearing in mind the requirements of the digital era, and not just an upgrade of the existing strategies and the existing way of collection, supported by some better technology. So as Rajiv mentioned about, say, the field collector or the guy who is sitting in front of the customer, well, we can improve this a bit technologically, like the guy having a tablet and this way knowing where to go, or we can apply some first principles design of how to build up our collection strategy by bearing in mind the economic and technological capabilities we have. And this is where it starts. A complete redefinition of our collections, and then we can support this new way of collection by the most modern technologies provided by a state-of-the-art collection platform. And one of the fundamental capabilities provided by such a platform is flexibility, the ease of change. Because what we see today is that change has never been as fast as now. Just think of it. Half a year ago, everybody was talking about, okay, there will be some inflation that will be with us for a few months. So that's why not too harsh actions have to be taken. Now, after a couple of months, all central banks are increasing the interest rates, and we are preparing for a longer inflationary, even maybe stagflationary period. And it's within half a year. So the major capability is flexibility for change. But the flexibility for change, and that's why I mentioned business, can not only come from the technology platform. Because if the bank has or platform that is very flexible for change, but the business cannot cope with this change, the organization of the collection department, the processes of collections are not prepared for this, then it's not worth too much. So that's the first thing, flexibility. And flexibility means many things, sorry. Microservices design so that only certain portions of the platform have to be touched. Cloud-based architecture, because this provides the flexibility of fast upgrades, scalability, quick reactions. Also, another very important aspect that we have already talked about is hyper-personalization, so that we have a data-driven platform that collects all the data available about the customer behavior, collection behavior, the user's behavior. And based on this, we can have data-driven strategies to reach the customer exactly when the customer would expect it, provide the relevant and only the relevant information, and give the customer the chance to be in the position to approach us and provide the necessary commitment. And as already mentioned, maybe the fourth component is, of course, self-service, because self-service gives the customer the chance to discuss this matter with the bank when the customer is best prepared, and giving us a promise, not by being pushed to a promise, but by knowing what this promise actually really means.
Perfect, Tamás, very clearly, this answer comes from someone who's been there, done that. So, I did start with the technology architecture, but, I love the way you spoke first about how the business has to be flexible, the business processes have to be flexible. Only then comes the technology flexibility, which of course also very important. I know we have very few minutes left. I'm going to slip in one quick poll question. Question is, how can a financial institution reduce NPLs, non-performing loans? And the options are acting based on early warning indicators, compulsory field visits for every missed payment, using alternate data sources to understand customers' financial behavior, providing flexibility for the borrowers to pay. What, according to you, is the most important way to reduce NPLs? The poll results, no surprises there. Starting with the early warning indicators, and the field visits, interestingly, is not one of the chosen options. Let's give people 10 seconds more, maybe. Yep, I'm going to hit end poll. Very interesting. It's the early warning indicators which clearly stands out. I know we are, on top of the hours, and we will start losing people. But I do want to, slip in one quick question, if I may, to Rajiv. Rajiv, I know this is debt collection topic and digital debt collection. Help me understand, closing the loop. How can the data from digital debt collection, how can be used at the start of the credit underwriting cycle? What do you think? How important is it?
Yeah, I think, conceptually it's the same as it always has been. The loop, the important is to have the loop collections going back into credit underwriting, right? If things are not going well, you see delinquencies going up. It's important to have regular reviews with the policy team and the underwriting team. Digitally, so with the assumption that you are a digital organization and you have digital collections and you have digital straight-through processes in terms of underwriting, that's the ideal world with the new digital banks and fintechs. And then, in case you don't need to really then you can actually set your parameters, and those can actually feed in based on the criteria into underwriting, and the score can get refreshed accordingly. And again, like I said, machine learning would look at the underwriting behavior, application scores then, and underwrite accounts accordingly. So concept is the same. It's just this is automatic and much smarter because it will learn a lot more. Again, I think it's a wishing for kind of situation. I've yet to see that so efficiently, but I'm sure there are organizations right now who are actually moving in that, and that's why they are so much more cost efficient. They can get things done so much faster. The time to yes to an application is barely a couple of seconds. So, and then of course they also tap into the external sources. Those are also important. So the collections, feedback plus all the other APIs that look at, maybe it's a bureau, whether it is social media, whichever is effective, even telecom, for example, some companies use telecom, organizations to actually feed in data. Again, it's fairly regulated. So you got to be very careful what you can use. And then you can have an application score, which can automatically just show up the moment the person enters his or her details.
Interesting, almost sounds like hyper personalization leading into hyper segmentation. So
right.
Perfect. I think
it's
on
like
that
make
note, yeah, perfect. I know on that note, we're quickly out of time on this webinar. Thank you so much to all my panelists, speakers. It was a real pleasure. I'm sure our attendees were able to take away something, if not one thing, two things, three things from this particular webinar. And I would like to thank all of you for joining in.